Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Now I'm going to start chapter number 3, CA Foundation Accounting. This is not only for CA Foundation but also for CMA Foundation as well as CS Foundation. So already 2 chapters I have completed. The first chapter regarding theoretical framework of accounting, where I have explained about the meaning of the term accounting, objectives, functions, users of accounting, how accounting is related with other disciplines, etc. etc. Then second chapter, I have completed about accounting concepts, conventions and principles. Now in this chapter number 3, I am going to explain you about capital and revenue expenditure. So before starting the chapter, take the screenshot of the points, then I'll explain every point in detail. Now, in examination, very frequently they will ask a theory question regarding the differences between capital expenditure and revenue expenditure. Apart from that, short problems will be given. True or false will be given. We have to identify whether the expenditure is capital expenditure or revenue expenditure. For that purpose, this video is going to be very important. Without understanding this, we cannot make the financial statements. Now, financial statements are the end product of accounting. So how to make the financial statements depends on capital and revenue expenditure. A student must know the difference between capital expenditure, revenue expenditure, capital receipt, revenue receipt. Then only he can be able to make the financial statements. Right? Now, first of all, for ascertaining the periodical results means the financial statements. Two statements are there. One statement is profit and loss account, that is income statement, to find out how much profit the business has earned during the accounting period. And secondly, balance sheet, the statement which shows the financial position of the business. So in order to make these periodical results in the form of profit and loss account and balance sheet, the nature of transactions should be analyzed. Whatever transactions the business has conducted during the year, that the transactions, the nature of those transactions should be studied in order to find out whether the transaction is a capital expenditure transaction or a revenue expenditure transaction, or capital receipt transaction or revenue receipt transaction. Until and unless this is classified, we cannot go and prepare the financial statements. This is a prerequisite. Now, revenue expenses relate to operations of the business of an accounting period. Any expenditure incurred to operate the activities, to conduct the activities. So, all expenditure related to operations of the business are called revenue expenditure, whose benefit do not expend beyond that period. That means whatever expenditure is incurred, the benefit from that expenditure will expire within the same accounting period. Simple example I'll give you. Salary paid to employees. During the year salary paid to employees, the employees will give the benefit during the year only. That means the benefit of paying the salary will expire within 1 year. The employees will not work for so many years simply by taking 1 year's salary. That means the benefit will be expired within the period. Capital expenditure generates enduring benefits and helps in revenue generation over more than one accounting period. Any expenditure which increases the earning capacity of the business, any expenditure which will give enduring benefits for a long period of time. Example, a machine is purchased for the business. The machine is purchased during the current accounting period. But do you think that the benefit will get only during current year? No. The benefit from the machine will accrue for a long period of time. The benefit will extend for more than 1 year. Next, revenue expenditure are transferred to profit and loss account in the year of spending, while capital expenditure will be transferred to balance sheet. So we have to analyze the transactions which are revenue transactions and which are capital transactions. The revenue transactions will go to profit and loss account. All revenue expenditure and revenue receipts will go to profit and loss account. Whereas capital expenditure and capital receipts will go to balance sheet. Now, however, distinction between, one more point, expenses are recognized in profit and loss account through matching concept. See, already in the previous video, I have explained you about matching concept where we have to match the current year revenue with current year expenditure. That is called matching concept. So when we apply the matching concept, then only we can be able to get the true profit. So this expenditure, we have to match with the revenue. So we have to find out whether the expenditure is matched with revenue or not for the current accounting period. If the expenditure is matching the revenue, then we should recognize the revenue expenditure. Now, however, distinction between capital and revenue creates considerable difficulty. We don't have a clear-cut demarcation that these are capital, these are revenue. It depends on the business. There is very thin demarcation line between capital and revenue. There are always chances that sometimes capital will be treated as revenue, revenue will be treated as capital depending on the circumstances. So we cannot completely distinguish this is capital, this is revenue. It may change. Now, considerations in determining capital and revenue expenditure. Now, how to determine that this expenditure is a capital expenditure or a revenue expenditure? So some factors must be taken into account. Some considerations are there which must be taken into account to decide whether it is a capital expenditure or a revenue expenditure. The first item is nature of business. To find out whether an expenditure is capital expenditure or revenue expenditure, it depends on the nature of the business. What is the nature? For example, for a furniture dealer means he is buying furniture and selling furniture. For this person, furniture dealer, furniture are the goods. The purchase of furniture is a revenue expenditure. Purchase of furniture, revenue. Because he is purchasing the furniture and selling. In this case, furniture are goods. So expenditure incurred on purchasing the furniture is revenue expenditure. The same furniture for other business houses is a capital expenditure. Because furniture are purchased not for sale, but using in the business. So the same furniture, for one business it is a revenue expenditure, other business it is a capital expenditure, depending on the nature of the business. Similarly, recurring nature of expenditure. So normally if expenditure is recurring every now and then it will be treated as a revenue expenditure. But some expenditure are there which are not recurring. It is non-recurring expenditure. It's a capital expenditure. Example, salary. Salaries will be paid periodically. Monthly salary we have to pay to the employees. Rent we have to pay monthly. Electricity bill we have to pay monthly. Then other telephone charges will be incurred regularly. So these are the regular expenditures: salary, rent, printing, postage, telephone, like this. These are called revenue expenditure. Whereas some non-recurring expenditure like purchasing an asset. An asset will not be purchased every day. The asset will not be purchased every month. Very rarely we will purchase the asset. So if an asset is non-recurring, it may be capital expenditure. If it is recurring, it's a revenue expenditure. Third one, purpose of expense. What is the purpose of expense? Whether the expenditure is incurred to generate the revenue or expenditure is incurred in order to create the earning capacity or increase the earning capacity. Example, if repair expenses, minor repair and maintenance expenditure is incurred on machinery, it's a revenue expenditure. Because when we use the machinery, repairing, maintenance will be there, recurring revenue expenditure. The same machinery, some huge repairs, heavy repairs are made. That means the earning capacity, the capacity of the machinery has increased. In that case, the major repair will be treated as a capital expenditure, right? Next, effect on revenue generating capacity of the business. Another consideration is effect on revenue generating capacity. Now we have to see whether by incurring the expenditure, revenue generating capacity will increase or not. If it is not increasing, if it is maintained, then it's a revenue expenditure. Example, salary paid, rent paid. By paying the salary, rent, our revenue generating capacity will not increase. It will be maintained. Whereas, purchasing an asset, incurring capital expenditure will increase the earning capacity. So, any expenditure will increase the earning capacity is a capital expenditure. Any expenditure which maintains the earning capacity is a revenue expenditure. Last one, maturity of the amount involved. Sorry, materiality. Actually, maturity is given here. The concept is materiality. If the amount is huge, if the large amount is there, I will make the correction here. Materiality of the amount, not maturity. Materiality of the amount. That means how much is the amount involved. Normally, if huge amount is involved, it's a capital expenditure. Whereas the amount involved is a smaller one, it may be treated as a revenue expenditure, right? So these are some of the considerations which must be taken into account while deciding whether the expenditure is capital expenditure or revenue expenditure. Now, few examples of capital expenditure and revenue expenditure. Capital expenditure contributes to the revenue earning capacity of a business over more than one accounting period. So whenever an expenditure is incurred, whose benefit will accrue for more than 1 year, it's a capital expenditure. Whereas revenue expenditure are incurred to generate revenue for a particular accounting period. So revenue expenditure is incurred only to generate the income for that accounting period only one accounting period. Whereas capital expenditure will increase the earning capacity over a long period of time. Then secondly, the revenue expenses are either occur in direct relation with the revenue or relation to accounting period. Some revenue expenditure is related with revenue and some revenue expenditure are related with the accounting period. Both are revenue expenditure only. Example, the cost of goods sold is in direct relation with the revenue. Because more cost of goods sold, more revenue. Less cost of goods sold, less revenue. So cost of goods sold like purchases, direct labor, this is directly related with revenue. These are revenue expenditure in relation to revenue. Some expenditure is there which is related to accounting period, not to revenue. Example, salary paid, rent paid. So the salary paid, rent paid does not have any link with the revenue. It is linked with the accounting period. Like this, some revenue expenditure related to revenue, some revenue expenditure related to accounting period. Similarly, capital expenditure may represent acquisition of tangible or intangible fixed asset for enduring future benefits. Capital expenditure is the expenditure incurred either in purchasing or improving the fixed assets. The fixed assets may be tangible fixed assets or intangible fixed assets. Next one is, therefore the benefit arising out of capital expenditure lasts for more than one accounting period, whereas arising from revenue expense expire in the same accounting period. The benefit from capital expenditure will go for a long period of time, whereas the benefit from revenue expenditure will expire within 1 year period. These are the differences between revenue expenditure and capital expenditure. And whatever you have learned now, those items we will apply in the coming problems in the coming videos. Now, capital receipts and revenue receipts. Just like we have capital expenditure and revenue expenditure, same way we have capital receipts and revenue receipts, right? Now, just as a clear distinction between capital and revenue expenditure, it is necessary in the same manner capital receipt must be distinguished from revenue receipt. Until and unless we divide capital receipt and revenue receipt, we will not get the true profit. The revenue receipt will be taken in profit and loss account, and capital receipt will be taken in the balance sheet. So receipts which are obtained in the course of normal business activity Any receipts which are received by the organization in the normal course of activities are called revenue receipts. In simple words, we can say the recurring receipts. The receipts which will occur to the business time to time, regularly, recurring. Then it is called revenue receipts. Example of revenue receipts are proceeds from revenue receipts are receipts from sale of goods or services. Every business will either provide the goods or provide the services. So any receipts from selling the goods or any receipts from providing the services are revenue receipts. Similarly, interest received, rent received, commission received, these are all called revenue receipts. Now, capital receipts which are not revenue in nature are capital receipts. Only two receipts are there. Any receipt which is not a revenue receipt is a capital receipt. That means the receipts which is not in the normal course of activities is called capital receipts. Example of capital receipts are sale of fixed assets. Sometimes a company will sell off a fixed asset which is no more required. It has become outdated. Then the business will sell away the fixed asset. So any sale proceed received from the sale of fixed asset is a capital receipt. Same way, investments are sold. Sometimes investments are there. These investments are sold and money is received. That is a capital receipt. Similarly, loan is taken from a bank. The loan is taken, so in future we have to repay back the loan. So receiving the loan is a capital receipt. Similarly, contribution made by the owners. In a sole trading concern, the owner has brought further capital. In partnership, the partners may bring further capital is a capital receipt. Similarly, a corporate entity, the company has issued the shares, issued the debentures and money is raised. That is a capital receipt. Now, revenue and capital receipt are recognized on accrual basis. And soon as the right to receipt is established, accrual concept always will be applied, whether it is a revenue or capital expenditure or revenue or capital receipt. Whenever it is accrued, it should be recognized, irrespective whether received or not. Similarly, revenue receipts are credited to profit and loss account. In profit and loss account, debit side we take revenue expenditure. Credit side we take revenue receipts. The capital receipts are not directly credited to profit and loss account. The capital receipts will go to the balance sheet. That's all. So this is the end of the discussion on capital and revenue expenditure. So if you watch this video 2 or 3 times, then you can be able to get all the points regarding capital expenditure and revenue expenditure, because frequently you may get a question on these topics also. Short questions you will get in examination. So if you are satisfied, give a like to the video, share my channel among your friends, among your group, so that more students can watch the video and enhance the knowledge, can face the foundation examination confidently and clear it in the first attempt itself. So give a like to the video, share my channel, subscribe if you have not yet subscribed, and buy the super thanks which is given below my video. Inshallah, we'll continue this discussion in the next video.